Hello, everyone. Today on the Final Bar, we'll do our normal Monday routine where we focus on three key areas of market analysis. We'll do top-down macro, look at some of the big major themes with the S&P rolling over big time going into the close, and NASDAQ as well. We'll talk sector rotation, how two sectors and only two are up year to date. Which two are those? What does that mean about prospects going forward? Number three, talk about individual stocks, look at some key names on the move and charts you should be aware of. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the action in the markets using the technical analysis toolkit, using stock charts to better understand what's happening by quantifying investor behavior and investor sentiment. When you look at a day like today, very much a choppy, volatile day. We've talked about the conditions of elevated volatility. Really started at the end of last year and continued to increase in January. So far, January saw increased volatility. The VIX staying pretty steadily above 20. We're seeing more of the same here in February so far. Big interesting move today, similar to Friday, where you had sort of a nice rally working in the afternoon after lunch, but then gave back a lot of those gains with today actually undercutting the lows of the day going into the close. So certainly more of a distribution feel to this session, and why that concerns me, as we talked about a little bit last week. The last 30 minutes showing a lot of distribution does not imply to me that institutions are going in and buying large amounts of stocks, because that would usually push the price higher if you get an influx of demand right into the close. That's when a lot of institutions are going to be making their move. So that distribution that you see going into the close certainly feels a little more bearish than bullish if you're thinking about the overall market conditions. We'll get to more of that here in a little bit. We have great guests coming up on the show. Had a lot of fun with our three guests last week. Coming up this week on the Final Bar, on Tuesday the 8th, we have Sam Burns from Mill Street Research in Boston. On Wednesday the 9th, Carolyn Borden, the Fibonacci Queen, joining us for the first time on the show. Then on Thursday, Ryan Dietrich from LPL Financials. Right, Ryan always does such a great job of giving us a market history lesson, what actually has happened, because a lot of times there's a sort of a myth busting that occurs when you dig into some of the actual details. So three great guests. Also, two other events to point out to you this week. We're doing our next virtual expo coming up at the Money Show. That's this Wednesday, February 9th, 2:30 p.m. Eastern. I will be presenting with Greg Schnell from gregschnell.com. We'll be doing a session called Trading Cannabis Stocks Using Price Momentum. If you've ever looked at the cannabis space and you want to understand those charts from a momentum perspective, definitely tune into that session. That's at stockcharts.com/money show to sign up for it. Also, our next webinar from Market Misbehavior will be coming up tomorrow on Tuesday, February 8th, 1 p.m. Eastern. I'll be doing a presentation called Breaking Down Breadth. There's a double meaning to that title. We will be breaking down some of the commonly used breadth techniques and what they mean, but also talk about how the conditions have been breaking down for a couple months. And we'll look at what the conditions are now, how that relates to previous market topping phases. Go to marketmisbehavior.com/breaking-down-breadth to sign up for that free event. Let's continue on with our market recap. As I mentioned today, a choppy day, sort of a volatile day, which makes sense given the uncertainty that we've seen. No real directional move. We sort of revolved around Friday's close, right around 4,500, but really sold off into the close. The S&P settling in just above 4480. That's down about 1/3% from Friday's close. The Nasdaq really was lagging behind for most of the day. And if you look at the sectors, you see communication services at the bottom, Facebook or Meta Platforms and Alphabet both pushing to the downside fairly significantly. That's keeping that sector down. And technology second from the bottom. The Dow actually finished flat for the day. Right here, just around 35,100, just below that. Mid caps and small caps up, but just a token amount, so outperforming large caps, but not by much. And the VIX right around 23 actually at the close. Looking at some other asset classes here, you have interest rates coming off. So the 10-year yield down around 192. Now remember that interest rates popped up pretty good on Friday with the 10-year getting to 190, 193 for the first time in quite some time. We hit 194 earlier today. So really above 190, this puts us well above the previous levels that we've experienced in the last 18 months or so. And what's interesting is we'll try to look at a chart of the 10-year yield and some upside objectives given the trajectory that we've seen so far. The dollar index flat using the UUP. Precious metals higher today, gold and silver. If you think of gold as sort of a safe haven, certainly followed through with that sort of idea today, with the GLD getting above 170. We really haven't seen the follow through on the upside from gold. A lot of that is because the dollar has been so strong. But if you get the dollar weakening, you could certainly make the argument for gold prices going higher from here. Energy, certainly the strongest of the 11 S&P sectors, by the way, as we'll get to a little later in today's show. A lot of movement in crypto land. And if you look, our top 10 coins that we track on our dashboard page, all in the green, with Bitcoin up 4%. Getting just about 44,000 here just before we're getting ready for the show. Ether up above 3150, but many others going to the upside as well. A lot of those coins obviously have been in longer term downtrends, sort of secular or cyclical downtrends for quite some time, bouncing off of some fairly weak levels. But Bitcoin's gained up about 10,000 points here in the last couple of weeks. So it's certainly a nice reversal to the upside after an extended period of a downtrend. I'd love to see a higher low in either of those charts, by the way. You really have not seen that yet. So that's something to pay attention to. On Friday's show, we talked a little bit about the market trend model that we refer to, and overall still remaining consistent, bearish on short term and medium term, still bullish on the long term. Time frame. The daily chart of the S&P, here's today's trading, really sort of at the midpoint of where we've been for the last 4 or 5 trading sessions. So no real change. If you think of that big move above the 200-day moving average, we've now sort of stalled in this range. And if you think about the S&P, or think about any chart as a series of ranges, sort of has a move, consolidates and sort of resets, and then you get the next move. We had the big move lower. This is when the S&P got to almost down to 4,200, which would be the first Fibonacci support level going back to sort of the longer term trend. We didn't quite get there. We got to 4,220 and then bounced back to the upside. Got back above the 200-day moving average, and in the last week, we've settled into this range, a 38.2% support level around 44.50, the 61.8% around 45.60. That's just using the January range as the high and the low. So if you look in the short term, that tactical time frame sort of bouncing within that range, and I will tell you, could be a lot a lot of value in paying attention to which way this would break. Right, option one, the bullish scenario, we get above 45.50, we get above the swing high from last week, and that would mean that last week we made a higher low. That means we can push on to 4,700 plus, regain previous all-time highs, perhaps. For the S&P 500, the more bearish scenario, which I will tell you is much more likely given what I've seen from individual stocks and breadth conditions and momentum deterioration, is that we break down through 44.50, we break down through the 200-day moving average, and we get back down at least into that range, that 4,200 to 4,300 range. That would be between that Fibonacci support level there around 4,200 and the lows from October and from mid-January. And again, just given the conditions that we've seen, the weakness in growth stocks, I could certainly see that being a more likely scenario. I just mentioned very quickly, just want to take another second and look at the chart of the 10-year. And I'm thinking Jeff Hughes was the one who was pointing out sort of this congestion phase. We were talking about the head and shoulders bottom, and he was actually talking about a much larger pattern where this is the big right shoulder, this is the head, and there's another left shoulder over there. If you take that as a big head and shoulders bottoming pattern, that gives you an upside objective of right around 3%, which would be the highs from the fourth quarter of 2018. But if you also look, I think you have what's called a head and shoulders continuation pattern, the big run higher into the second quarter of 2021. You have the left shoulder, the head, the right shoulder. If you take that neckline and take the height of that pattern, project that up, that goes up to about 2.20, 2.25%. Which would take us a little further, and that would give us to the 61.8% retracement of that big drop in yields going into the March 2020 low. So I think 225 is the minimum of where we see the 10-year go to. I don't think 3% is unreasonable before all is said and done, and we get the rate hikes and the potential ripple effects of that sort of movement here from the Fed. Our next segment is called sector setups. What we like to do now that we've talked about the big picture, talk about potential weakness in stocks, some of the deterioration, rising interest rates. Perfect segue into talking about the 11 S&P sectors and which sectors tend to do well in that sort of environment. We're looking at the weekly RRG. I had Julius DeKempener on my show last week, and if you missed that, I'd encourage you to go back and review it. Go to stockchartstv.com. You can see that interview, but we talked about breaking up the 11 S&P sectors into three buckets. Morningstar has started using three separate buckets. I think it's cyclicals, sensitive, economically sensitive, and defensive, and looking at the three of those separately and seeing how they're performing relative to the benchmark and relative to one another. Here, we're looking at all 11 S&P sectors together, and you can see in this case how energy is just by far the strongest outlier. If you look at any sort of measure of momentum, of trend, of participation, it's sort of energy and everything else. And financials are probably a close second. It's kind of caught in the wilderness here, but you can see it's probably heading in the right direction, heading northeast better than any of the other sectors after energy. So in general, you want things that are heading northeast, ideally as they're getting into that leading quadrant, because that tells you that they're emerging in a position of strength and the conditions are improving, right? The momentum is improving and showing you that there's further upside potential because of that. Flip those over and you see why technology, consumer discretionary deteriorating quite a bit. Materials actually as well heading in the wrong direction. So things heading southwest, what I would call the direction of deterioration, is showing you that it's underperforming and that the momentum is really accelerating on the downside. So very much a value versus growth feel to the RRG that has been building. It's not just this week. We've been talking about that for weeks and weeks, that rotation away from growth and into value. And today was just an example of that theme playing out on an individual trading day. Look at the 11 S&P sectors using the candle glance function. And if you're not super familiar with stock charts, once you get a list of anything, a list of stocks, ETFs, indexes, whatever it is, you put them in a chart list, and then you can use what's called a candle glance view. And it basically is sort of the equivalent of taking a bunch of paper charts and throwing them on a table and seeing what looks like what. It is a really cool way to compare patterns and look for outliers and see what looks similar and what looks different. It's a great way to try to make sense of a portfolio or of a watch list and just determine where you really want to focus your attention, right? You don't need to be looking at all of these at the same time. You want to focus on where the opportunities might be. And as you look at these 11 S&P sectors on the screen now, my question to you, which of these stand out? I'll give you a second, but I think it's pretty clear. One of these, obviously, as an outlier, right? Only two of them are up year to date. Consumer staples is not far behind, but it's energy, which is up double digits, while most things are actually down so far in 2022. And financials, who just narrowly got back to the positive with the XLF getting back above 40 over the last week. When we look at the chart of energy, again, it's a classic technical pattern of a rally, a consolidation phase, and then a breakout. So what we call a big base breakout, right? A basing pattern is sort of a parallel level of horizontal support and horizontal resistance. The market has essentially told you this is where energy stocks should be. This is right about the level. Buyers and sellers in general are in agreement. Even though you rotate around sort of 45 to 52, we keep revolving around that level. So literally buyers and sellers are even. This is kind of where the XLE should be. But look at how something changed in the fourth quarter of last year. You see the breakout above resistance, a retest where resistance becomes support, and then we keep rotating higher. And that's just this beautiful rotation back to a reacquisition of the uptrend. It might be a way to say that, a renewal of the bullish phase. Look at how the relative strength also, as the price was breaking out, the relative strength really starts to improve. And obviously, if you start the clock on December 31st, look at how the relative strength was sort of flat after it had broken out, and then look at how that changed, and you really see that move back to the upside. So some of the growthy stuff here was starting to show some signs of interest, and the question was, where are we going to see the opportunities in the new year? It's been energy and everything else in a big way, and you're seeing that on the improved price characteristics, while most things are going down, but especially on the relative strength, which is what's so encouraging there. Same thing with financials, maybe a less exciting price action, right? Less exciting on an absolute basis because you're still sort of chopping around a little bit, but you see a very similar pattern to what you saw with energy, right? The consolidation phase in the middle of last year, the breakout, you could consider some of these sort of retesting that breakout level, although you undercut it a little bit. We're now rotating back to the upside. As long as we remain above that breakout level here, remaining above the 200-day moving average, sort of a nice trend that's continuing higher. And look at how the relative strength is improving again, given a lot of the choppiness and downward movement in some of the other sectors out there. So, as Tom Bowley, one of our fellow Stock Charts contributors, has mentioned a number of times, if you want to outperform the S&P 500, you need to own stocks that are outperforming the S&P 500. I'm seeing that really strong in two sectors: financials and certainly energy. It's interesting when we come back after the break, we'll look at some of the energy stocks. I'll try to make a note to do so, because if the question is how long, what about some of these that have had such good runs? I get the idea of lightening up to try to lock in some of those profits. However, my experience has been charts that are working, you want to stick with what's working. One of the worst mistakes you can make is sell your best performers and hold on to your worst performers. That's literally the opposite of what you want to do. You want to let your winners run and cut some of the things that are not working. When you see the strength in energy, when you see the strength in financials, that is one of the reasons why communication services look so ugly. Look at how energy was rotating to an uptrend, and that complete opposite rotation in communication services. Instead of the relative strength going to the upside like you saw with the XLE, look at how it's just continuing to rotate to the downside. I don't see a sign here that this downtrend is over. I see further and further confirmation that you, on an allocation basis, really don't want to be thinking about the XLC right about here. We need to take a quick break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the market action using a lot of charts. We have a couple of announcements before we get to our next segment, Shifting Stocks. First off, we love to get your questions. It's been so great to hear from many of you. Feedback on our show, feedback about how we're communicating some of these ideas, but particularly questions that are coming up as you were trying to analyze your own charts. You can get your questions to us via email, thefinalbar@stockcharts.com, via Twitter @finalbarsctv, on our YouTube channel. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions and we'll hope to answer one of yours in our next mailbag segment, Tuesday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. It is completely free. There's so much great content on there. Special events from January, looking at the year 2022 and what to expect from people like Larry Williams and Martin Pring. Our latest episode of The Pitch, where we've had some really good ideas about where to be positioned in this sort of uncertain environment, and so much more. Go to StockChartsTV.com, or on your mobile device, just search on the App Store for Stock Charts TV on demand. Our next segment is Shifting Stocks. The Monday routine is we start big picture with the macro environment. We then go through some sectors and talk about some general themes. We then look at some individual names and see which charts, see which stocks are getting it done. It's interesting, starting with Tyson Foods here, TSN. There are a lot of earnings again this week. Last 2 weeks, it's been sort of a FANG-heavy earnings. This one is sort of a mix. It's sort of a lot of ARK Innovation Fund type of names, sort of those sort of things. And I'm going down the list. You have Take-Two after the close today, Peloton, Enphase, Lyft, Uber, Zynga, Sonos, Affirm, Twitter, Expedia, Upwork, Dexcom, HubSpot. These are all in the next couple days. So certainly these names in general have been under quite a bit of pressure. And sorry, I mentioned Tyson. I promise I'll come back to that here in a second. Charts like Enphase, this group of renewable energy equipment, Enphase, Plug Power, these are all the solar names like First Solar, Solar Edge. These are ones that have come off quite a bit. A lot of them, attempted to make new highs toward the end of last year and failed, right? Sort of broke above resistance, but then came right back down to earth, and now are testing support. So I get the argument for buying on a relatively weak position. If you think of that downside risk potential to those previous lows versus the upside potential of getting back to the previous highs, not a bad risk reward if you think of it that way. And the challenge, I would say, the opportunity is that earnings could provide an upside catalyst with some of those names. The challenge, though, as we saw with with charts like Meta Platforms and others is an earnings miss can just as easily rupture a chart very quickly. And this week, I think by the end of this week, we'll get that question answered. Is this support that is just a bounce before the next big leg downwards? Or is this the beginning of some sort of recovery? I think this could be a really interesting week to watch some of those names that I mentioned, particularly this group, renewable energy equipment. See which way these earnings start to play out. I get it, as long as you manage your risk at this point. I could see the value of taking a shot at something like that. Now, compare that chart with something like Tyson Foods. We've talked about consumer staples. Over the long term, it's just not been a great sector on a relative basis. So you're thinking in terms of, sector rotation and which sectors you might want to overweight or underweight. It's been hard to justify consumer staples for quite some time. And even now you're seeing plenty of weakness on a broader basis. But I would say more and more, some of the better charts and some of the more improved characteristics I'm seeing are in consumer staples. Tyson Foods overall has been in a pretty good shape for a while. If you see, the relative strength has been improving up until today. On Friday, we sort of pulled back a bit and we're retesting right back to the 50-day moving average, which has been support a number of times over the last 6 months or so. But really, this resistance level in May, August, September of October of last year, and then rotating above, there was a nice breakout above resistance. It held that breakout level and then continued higher. So this gap higher, up about 12%, is sort of the latest follow through. After many, what's interesting about Tyson is it's nearing that really important big round number of $100. And I will tell you, it might seem silly that a stock would find support or resistance at $100. Look at a bunch of charts and you will find that more often than not, that's exactly what happens. And I think it's a psychological thing, right? Is a phenomenon where we see that there's another digit there. And it's where you naturally question whether or not this stock or this ETF is justifying adding another digits to its price value. So certainly be aware of that as we gapped higher and very, very close to that 100 level. I mentioned some of the earnings names, and I would look at something like CVX and others. Funny how close the Chevron and Tyson Foods, how similar those two charts look as I'm flipping from one to the other. But obviously, energy has been on a tear. And when I asked about energy, right, have you missed it? Right? Should I be buying it now? Isn't it too late? I used to think so. And when I worked with a lot of hedge fund managers and hedge fund traders, they would be very skeptical of a chart like this because they were trained to buy buy weakness and sell strength, right? Buy low and sell high. And then usually on a much shorter time frame than I'm demonstrating here. But the idea is the same. You probably wouldn't want to buy things breaking out because you've sort of missed out. You want to buy them before they break out. But there is a whole momentum-based approach, a trend-following approach that argues that buying the new highs list is actually pretty decent. And it's been well proven out that the momentum factor, if you look it up, is sort of what that is describing. And people like Andrew Lowe and others have demonstrated that momentum, what was his name? Robert Levy, I forget his name, who wrote seminal work in the 1960s talking about, basically relative strength investing and how to bet on stocks that have done well and underweight stocks haven't. And people like Mark Chaikin and William O'Neill and many others have made a career off of demonstrating the value of that approach. And all of that is an intro to say, I'm not super afraid to buy or own names that have had pretty good runs. Because if you look back, a lot of stocks that have had exceptional runs started out having pretty good runs before they continued on. Now, from a tactical perspective, would it be better to wait until there's a bit of a short-term pullback? Of course, that's always easier to get in. Then you're not chasing things and it feels a little better. So opportunistically looking for short-term weakness as opportunities to scale into names like that, I think makes a ton of sense. That's certainly backed up by the long-term data if you look here. So I don't think necessarily it's too late on charts like this. The chart will tell you when it's too late, and that's when the price stops going higher. That's when the price starts to rotate lower. We're not seeing that. We're not seeing that yet. Where else was I going to go? I was jotting down some of these names. Oh yeah, cruise lines. So let's look at some of the cruise lines. Some of the better performers today, if we look on the dashboard, look at the market movers. These are just stocks that are up on the day. Tyson Foods #1, and then it's Royal Caribbean, Norwegian Cruise Lines, CCL, Carnival. You have American Airlines. It's gambling stocks, a whole United. It's a whole travel thing, travel and tourism at the top of the list. The problem I have with ideas like that is just the fact that it's still arguably in a downtrend. It depends on how you define it. And I think you could make the argument on something like CCL that you've now made a higher low, right? If you assume that we're now rotating out of this, we had a lower low in early December, which was undercutting the lows from most of last year. Then all of a sudden we make some higher lows, and now we're rotating back to the upside. So, looking at a name and thinking of something like 18 as a stop because that's the most recent swing low. As long as we hold that, the chart is improving. I get the argument. Making a trend line here using those previous highs, waiting for confirmation of breaking above the trend line, which we've probably not had yet, breaking above the previous swing high, breaking above the 200-day moving average. Those would be the types of things that will make me feature this sort of chart on the show and mention things like Carnival are really rotating to the upside. Now it's a potential idea. And I think if you're more aggressive, if you have a pretty healthy risk appetite, a chart like this could make a ton of sense to you. And then maybe you scale more into it when you start to break above those previous resistance levels. But potentially something starting to build here. And again, I think charts like CCL holding their previous swing lows around 18 there could make it a compelling chart. Otherwise, this is something that is just continuing on in a period of uncertainty. Also, just want to mention there, a lot of earnings this week. I'd encourage you to look at the symbol summary page. If you bring up a stock and click on that symbol summary, that'll tell you when the company is going to report earnings next. Pfizer reports before the open tomorrow, and I'm not going to comment on the earnings itself, but I will tell you the chart of Pfizer is compelling because you had the high in August of last year. We pulled back, we broke above, and then tested that high from before. So holding $50, pretty key. We tested that in early December as well. That's a level I would be focused on if you're looking at that name going into earnings before the open tomorrow. We need to wrap today's show and go to the 3 in 3, 3 charts in 3 minutes today, brought to you by Trader Your Brokerage. If you go to our StockCharts ACP platform, you can trade stocks directly from the charts. Click on the Trader Your logo in the bottom right corner of that screen. Chart number 1 is the energy sector, ticker XLE. We talked in our sector setups segment. We talked about the energy sector as being by far the top performer of the year, and longer term on energy. It's been the stepwise motion, the big move in the fourth quarter of 20, first quarter of 21, this big sideways period as other sectors were really outperforming. But then look at how that changed. You have the breakout, the retest, and now rotating to the upside. And again, a lot of those names are already up a lot. It's certainly outperformed other sectors by quite a bit. The relative strength has been very strong. I would be inclined to continue to follow that as much as humanly possible because that is a strong uptrend that is not showing, as of yet, any signs of abating. Chart number 2 is Meta Platforms, ticker FB. And if we look at Meta, you can see we've undercut today the 61.8% retracement level. We talked about this chart as a great illustration of the Fibonacci methodology, right? If you take the low from March 2020, take the high from September of 2021, we found support here at the 38.2% retracement. We bounced higher, big gap lower to these lows from 2020 and early 2021. We then, as of Friday, traded right down to the 61.8% retracement low around 231.50. As of today, down another 5%. We have undercut that Fibonacci level. The problem here, if you're a fan of Meta Platforms, is from a Fibonacci perspective, there's not much left until you get all the way down to 137. It's basically implying a retest of those lows, which would be a pretty significant, that's almost a 100-point haircut from where from that support level, another 80 points below where we're at right now. I don't know if that's necessarily going to be the case, but the fact that we've broken down through that last support level certainly tells me this is not the time to be looking at that sort of chart. I'd be looking for signs of accumulation, looking for some signs of improvement, sign that buying power is building. It is not there as of today. Finally, we talked about Carnival Cruise Lines. I didn't put the Fibonacci retracements on there before, but if you look, this is actually a really great illustration as well. Take the low from April of 2020 in this case, the high from June of 2021. You can see we've bounced off of the 50, the 38.2%, the 61.8%, just continue to bounce off of those levels. I mentioned using the lows around 18. I could argue making the lows from the last Fibonacci level, which takes us down to those December lows. That's your downside risk. The question is, what's the upside potential? And are you uncomfortable taking on that potential risk to the downside for the opportunity to ride that chart potentially higher? With any of these names, given the uncertainty, it's all about looking at opportunities, but more importantly, I would argue about managing downside risk. Folks, that is our show. Thank you so much for joining us every weekday after the close for the Final Bar. All of our previous episodes and all of our interviews at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.